Hey there, and welcome back to the channel. Today we're diving into a topic that I think will really help beginners. What are the best investments to start with? If you're just starting out, investing can feel like a total maze. So many choices, so much jargon. It's easy to feel overwhelmed. But don't worry, I've got you. We're going to break it all down and keep it simple. In this video, we'll look at three solid options: stock index funds, stock ETFs, and bond funds, whether that's bond ETFs like BND or bond index funds like VBTLX. By the end, you'll know what each one is, why they're beginner-friendly, and how to build a portfolio that fits your age and your goals. Let's get into it. First up, stock index funds. Think of it this way. You want to invest in the stock market, but you don't want to spend hours researching individual companies. That's where index funds come in. An index fund is a type of mutual fund that tracks a specific market index, giving you exposure to a broad group of stocks at once. Take the S&P 500, for example. It's an index of 500 of the largest U.S. companies by market value. When you invest in an S&P 500 index fund, you're buying a tiny slice of all those companies at once. So why do beginners love index funds? Diversification. You're instantly spread across many companies, which helps reduce risk. Low cost. These funds usually have lower fees because they're not actively managed. Simplicity. You invest and the fund does the rest. Some great examples to check out are VFIAX, Vanguard 500 Index Fund, VTSAX, Vanguard Total Stock Market Index Fund, and VTIAX, Vanguard Total International Stock Index Fund, which gives you exposure to U.S. large-cap stocks, the entire U.S. market, or even global stocks, all in one click. Next up, stock ETFs, exchange-traded funds. Now, you might be thinking, wait, aren't some index funds also ETFs? And yep, you're right. Many index funds are structured as ETFs, meaning they track the same indexes as mutual funds, but trade like regular stocks. The key difference is ETFs trade throughout the day on the stock market. You can buy or sell them anytime the market is open. So what makes ETFs a great pick for beginners? Flexibility, trade them anytime the market is open. Diversification, many ETFs give you exposure to entire sectors, commodities, or global markets. Low cost, they tend to have lower fees than traditional mutual funds. And transparency, you can easily see what's inside the ETF. A few beginner-friendly examples are VOO, Vanguard S&P 500 ETF, VTI, Vanguard Total Stock Market ETF, and VYM, Vanguard High Dividend Yield ETF, which focuses on U.S. stocks that pay higher dividends. Now let's talk about bond funds. If stocks are about owning a piece of a company, bonds are more like lending money. When you invest in bonds, you're essentially giving a loan to a government or corporation, and they pay you interest in return. Instead of buying individual bonds, which can be tricky and expensive, you can invest in bond funds, either bond ETFs or bond index mutual funds. These funds pool money from many investors to buy hundreds or even thousands of bonds at once, giving you instant diversification. So why include bond funds in your portfolio? Stability. They're generally less volatile than stock funds, which helps protect your portfolio. Income. They pay regular interest, providing a steady stream of cash flow. Diversification. A single bond fund spreads your investment across many types of bonds, government, corporate, and sometimes international bonds. And simplicity. No need to worry about individual bond maturity dates or credit ratings. The fund handles all that for you. Some beginner-friendly options include BND, Vanguard Total Bond Market ETF, VBTLX, Vanguard Total Bond Market Index Fund, and AGG, iShares Core U.S. Aggregate Bond ETF. These funds make it easy to add balance and stability to your portfolio, whether you're just starting out or preparing for retirement. All right, so how do you mix these investments based on your age? If you're in your 20s or 30s, you've got time on your side. That means you can afford to take more risks and focus on growth. Go heavier on stock index funds and ETFs, somewhere around 80 to 90% of your portfolio. Stick with broad market funds like VTI, VOO, or VT for diversified stock exposure. Keep bonds in the range of 10 to 20%. A bond ETF like BND can add stability without slowing down your long-term growth. Now, if you're in your 50s or 60s or getting closer to retirement, your priorities shift. It's more about protecting what you've built and generating reliable income. Scale back your stock exposure to around 40 to 60%. Increase your bond allocation to about 40 to 60% as well. That balance helps cushion your portfolio against volatility while providing steady interest income. For the bond side, look into broad, diversified funds like BND, VBTLX, or AGG for extra security. Here's the bottom line. Investing isn't a sprint. It's a marathon. The most important thing is to start, even if it's just with a small amount. Time and consistency are your best friends. So what kind of investments are you thinking about right now? Drop a comment below and let me know. And if this video helped you out, give it a thumbs up, subscribe, and hit that notification bell so you don't miss the next one. Thanks for watching, and I'll see you next time.